G'day everyone, welcome to the weekend general update on global markets. US rally still going, no signs of weakening at this stage. So it's moving into a period where we could expect maybe a little bit more volatility, a little bit of weakness, but really no signs of it yet. So let's have a look at what happened last week. The S&P index ended up gaining 25 points on the week. Formed a short-term double top around the all-time highs, so that's pretty normal. Markets aren't going to, necessarily have the momentum just to go straight through again. So it's pretty normal for this to happen. It really depends on how deeply the price pulls back, and we'll take a look at that in just a minute. So no sign of broad market weakness looking at the Russell 2000 index, which is stocks 1,000 to 3,000 market cap. It's doing as well as the S&P and the Dow Jones, so people aren't too worried in the market at the moment. So phase two still prevailing in the US. And if you recall last week, I covered the bond market and how we need to watch that for signs of perhaps a breakout to the upside, which would be a big negative for stocks. There was very little movement in the bond market, not much happening there, so it's the same situation as we were in last week. Let's move over and have a look at the S&P 500. So you can see we really haven't had any increase in volatility. It's maybe just forming a bit of a rounding top here, similar to what we saw back here in early to mid-January. We had a bit of a rounding top. It went down, pulled back about 5%, came back to the 150-day moving average, and then just promptly shot off again. There's no big candles here. We've got candles closing on their highs, candles closing on their lows, so it's a bit of a mixed bag. As you can see, we had a bit of a pullback. Didn't even have enough strength to get down to this first Fibonacci level of the most minor retracement. So that's a real sign of strength. The market went back up again and has formed this double top and then eased back on Friday. So to me, the action on Friday looked pretty technical. It was just a bit of a rejection off that short-term double top. What I'd really be looking for would be a pullback to maybe this 1793 area, which lines up reasonably well with the first retracement level of the bigger picture. So the bigger picture picking up the last time we had a reasonably meaningful pullback, and that comes in at about 1773. So until we see a pullback towards that area, 1792 or possibly 1773, then there really is no retracement in the market at all, and it's continuing to barrel on. So I guess what we'd be looking for now, we've now got a range between 1840 and about 1885. So we're looking for a breakout on either side of that short-term range, and that would be a signal for what's likely to unfold for the next few weeks or possibly even for a few months. But it's all calm on the American front at this stage. Moving on now to the Australian index, the ASX 200 ended up gaining just 9 points, pretty disappointing for the week. The banks were the best performers, but marginally, they didn't really go up that much. And the main drag, again, over China, people still always seem to need to have something to worry about, and China seems to be the one these days. So some fears over China were a major drag on BHP and Rio and Fortescue and stocks of that nature. So not a lot of change in the Australian market. And when we have a look at that index, you can see that it's considerably weaker than the American market. We haven't had that big run up that the American market has. But look, it's still got a little bit of an upward bias to it. So it'll probably just keep tracking along in the same direction as the US market, but probably tracking along at a slower pace. Moving on to gold now. Gold had lost $33 on the week, which was a retracement of most of what it had made in the prior week. So we're roughly back to where we were 2 weeks ago with gold. Still looking for a break above 1440. Look, that could be months away because we're still overall in a big phase one base for gold and also for gold stocks. Whilst there has been some nice moves and they've been quite tradable moves, when you step back and take a look at the big picture, then we're still in phase one. We haven't had the confirmed breakouts yet, but doesn't mean to say you can't make money from gold stocks in this phase of the market, but you need to be pretty sharp on your feet to do so. We saw a similar move in the GDX, pull back a bit, gave back a fair bit of the previous week's gains, but that was all. Silver ended up down 5%, so it was a bigger move on silver, and it continues to be a little bit under pressure. It's pulled back now to the breakout level. And copper was steady at 294 after the big falls from the previous week. And crude oil still holding around about the $100 mark. That's West Texas Intermediate crude still sitting there just under the 100 mark. Let's take a look at gold. So we had a nice move off this double bottom down here at 1180. We moved up to around the 1330, 1340 level, which was the 61.8% retracement of this move that started down on the 28th of August. We stayed sideways there for a while, which is an encouraging sign. Very little pullback, so that's good. We then broke above it quite decisively, but then fairly quickly failed again, and we've pulled back just to the bottom of that little consolidation. So fairly important here that gold doesn't break down too much further. Otherwise, we might be heading back down to around the 1280 mark, which would also be on these highs from late January. The ultimate confirmation is a move above 1435, 1440. So if we just pan back and look at gold on a bigger picture level, you can see that really we're still in phase one. So we've had our phase four decline. This is a big phase one base when you look at it on this sort of level. So still looking for that ultimate confirmation, but quite tradable in here. Silver, nice move a few weeks ago, but has pulled back to the breakout level. It was pretty much all downhill last week in silver, but we've only just come back down to that level. So as long as this level holds, then we're still a good chance of seeing quite an explosive move in silver over the coming months. And finally, just to check on the GDX index, it looks very much the same as the American stock market does. So no real change there. So there's the copper chart just after the plunge a couple of weeks ago, holding steady. So from an overall strategic approach, we're getting close to moving into the April-May period, which tends to be seasonally weaker. It doesn't happen every year, but there is a tendency for that to be the start of a weaker period in the market. So as I indicated last week, effective trading is about protecting capital first and foremost. That is your primary task. Make sure that you are doing all the things in terms of risk management to protect your capital. I would also start to think about freeing up a little bit of cash. There will be opportunities in the next month or two. As we go into this period, you just need to be more highly selective about what stocks you buy and what entry prices you take. So a lot more care needed over the next few months. Gold stocks, they're still building in phase one, and I really read it as a consolidation before the real explosive move. Now that could be 2, 3, 4 months away, or it could be in a couple of weeks' time. It probably depends a fair bit on some factors like what's happening in the Ukraine, and also part of the Chinese buying cycle as well. So the patterns are pretty clear with gold about what is most likely to happen, but of course we don't know exactly when that will be. So that's the run through for this week. If anyone would like to contact me with regard to their own trading, then that's the web address and that's my email address. Happy to assist anyone that wants to improve their trading skills. So that's it for this week. Cheers.